Okay, let's unpack this. Have you ever stopped to think about what truly drives the value of today's biggest companies? It's often not what you can actually see or, touch. Consider Disney for a second. What's really more valuable? It's huge theme park rides, or, say, Mickey Mouse himself. Or Google. Is it their office buildings? Or is it that incredibly powerful search algorithm? Today, we're taking a deep dive into something really fascinating, foundational, and maybe a bit mysterious in accounting: intangible assets. These are assets you can't physically hold, but wow, are they critical to a company's financial health and its future? We're digging into Chapter 11 of Intermediate Accounting by Kieso, Weygandt, and Warfield. We'll break down what these assets are, why they're so important, and how they actually show up on the financials.
It is fascinating, isn't it? Just how much the whole global economy has shifted. If you think back, say, to 1985, the giants then, like ExxonMobil, GE, they relied heavily on tangible assets, physical stuff, property, plants, equipment. That was often over half their value. But fast forward to like 2020, the top five are Apple, Microsoft, Amazon, Alphabet, Meta, all tech. And for them, intangible assets make up something like over 80% of their total company value. It's huge. We're talking over $21 trillion in value. It's just for S&P 500 companies coming from intangibles. That's actually 90% of their total value now. So understanding this category, it's absolutely essential for any investor, any decision maker today. You just can't ignore it.
Right. So our mission today is really to demystify these hidden powerhouses of value. We'll cover everything from patents to brand names, maybe even get into that slightly elusive concept called goodwill. The goal is you'll walk away with a much clearer picture of why these assets matter so much, how they're accounted for, and what it all means for business decisions. So let's start right at the beginning. What exactly are we talking about when we say intangible assets?
Okay, well, essentially they have two core characteristics. First, as you said, they lack physical existence. Unlike a factory or a delivery truck, you can't touch them. Their value comes from the rights or privileges they give a company. Second, they're not financial instruments. Things like cash or stocks, they get value from a future claim to cash, right? Intangibles derive their value from how they're used directly in the company's operations. Think about Coca-Cola's secret formula, or Amazon Prime's massive subscriber base. For those companies, these are arguably their most important assets, much more so than physical buildings.
And why is really getting a handle on this so crucial for us? For anyone trying to read a financial statement or make investment decisions?
Well, it really gets down to understanding a company's true value. If, like we just mentioned, 90% of the S&P 500's market value is tied up in these intangibles.
90%. That number is just staggering.
It really is. It means a traditional balance sheet, which focuses heavily on tangible assets, might not be giving you the full story, not even close sometimes. Investors, creditors, even internal managers, they need good information on these assets because they are absolutely critical for generating future cash flows. That's what drives success long term.
Okay, so that brings us to the really interesting part, doesn't it? How do you account for something you can't see? How do you put a number on it? It sounds like it would be incredibly complicated.
Well, the accounting is actually pretty similar in principle to how we handle long-lived tangible assets, like buildings or equipment. But there are some key distinctions, especially around how the asset comes into existence for the company. So if a company purchases an intangible asset, let's use the example of Universal Music Group buying Bob Dylan's copyrights for, say, $300 million. That cost, including all the acquisition fees, legal fees, everything related, it gets capitalized.
Capitalized meaning it goes on the balance sheet as an asset.
Exactly. It's recorded as an asset because the expectation is that it will provide benefits over time, and those future cash flows are reasonably traceable back to that specific purchase, so you spread the cost. But here's where it gets really interesting and maybe counterintuitive. If an intangible asset is internally created by the company itself, generally those costs are expensed as they're incurred.
Expense, so written off immediately against income?
Pretty much.
Yeah.
Think about Alphabet, Google's parent. They spend billions, tens of billions on R&D every year. Almost all of that hits the income statement as an expense right away.
But why the difference? That seems odd if both create value.
It comes down to uncertainty and reliability. It's often incredibly difficult to reliably associate specific internal costs with the specific future benefits you'll get from the resulting intangible. How much of that R&D really created that specific successful product? Because of that uncertainty, GAAP, that's the U.S. accounting standard, requires this more conservative approach. Expense it now. Prioritize verifiable numbers over potentially subjective estimates of future value.
Okay, that distinction is really important. Now, let's talk about the life of these assets. Do they all just last forever, theoretically? Or do some wear out, so to speak?
Excellent question. That's another key classification.
Mhm.
Intangible assets fall into two buckets, limited life and indefinite life. And the accounting follows from that classification. So limited life intangibles. These, as the name suggests, have a foreseeable limit on their useful life. The period over which they'll contribute to the company's cash flows is finite. For these, companies amortize their cost over that useful life.
Amortization. That's like depreciation for intangible assets, right? Spreading the cost.
Exactly. It's the systematic allocation of the asset's cost to expense over the period it provides benefits. Usually it's done using the straight line method unless another pattern better reflects how the asset's economic benefits are used up. So if a company, say U2D Count, has a brand name with an estimated 8-year useful life, they'd amortize its capitalized cost over those 8 years, maybe minus any residual value. Then you have indefinite life intangibles. These have no foreseeable limit on the period over which they are expected to generate cash flows. For these assets, companies do not amortize them.
No amortization at all.
Nope. Think of a really strong trademark like Kleenex or Pepsi-Cola. As long as the company maintains them, potentially through minimal renewal costs, they're expected to generate value indefinitely. So if a company like DoubleClick Inc. acquires a trademark that's renewable every 10 years and they expect it to generate cash flows essentially forever, they wouldn't amortize its cost.
Okay, that makes sense. But what happens if an asset, whether it's limited life or indefinite life, starts to lose its value? Maybe technology changes or the market shifts. How do companies account for that drop?
That brings us to another really important concept, impairment.
Mm.
Companies can't just keep assets on the books at their original cost if the value has clearly declined. They have to regularly evaluate their intangibles for impairment, which basically means checking if the carrying amount, the value on the balance sheet, might not be recoverable. For limited life intangibles, it's generally a two-step process, similar to how we test property, plant, and equipment. Step one is the recoverability test. You compare the sum of the expected undiscounted future cash flows the asset will generate to its current carrying value.
Undiscounted, so just the raw future cash flow numbers.
Right. If those expected future cash flows are less than the carrying amount, then, there might be an impairment. That's the trigger. Step two, if it fails the recoverability test, is the fair value test. You measure the impairment loss as the difference between the carrying value and the asset's fair value, what it could be sold for today. For example, if Lighthouse Inc. has a patent on its books for $60 million, but due to new tech, it's only expected to generate $35 million in future undiscounted cash flows. Well, it fails step one. If its current fair value is, say, only $20 million, they'd record a $40 million impairment loss, 60 meters, 20 meters. And here's a critical point. Once you write down an asset due to impairment, that new lower value becomes its new cost basis. You cannot reverse that impairment loss later under GAAP, even if the value recovers.
Wow. Okay, so the write-down is permanent.
Now, for indefinite life intangibles, the impairment test is actually a bit simpler. It's just a one-step fair value test. You directly compare the carrying value of the asset to its current fair value. If the carrying value is greater than the fair value, boom, you recognize an impairment loss for the difference. So imagine Archon Radio has a broadcast license with a $2 million carrying value. But due to new FCC auctions or market changes, its fair value drops to $1.5 million.
They'd just record a $500,000 loss.
Exactly, a $500,000 impairment loss. And again, just like with limited life assets, once that loss is recorded under GAAP, it cannot be reversed later on, even if the fair value bounces back up. Companies can also do an optional qualitative assessment first, kind of a quick check, to see if impairment is more likely than not. If things look okay, they might skip the quantitative test for that year, which saves time and money.
So let's connect this back. What does this impairment process mean for someone analyzing a company? It seems like a really crucial area for financial analysis.
It definitely is. It really underscores the conservative nature of financial reporting, especially under GAAP. The fact that you can't write assets back up after an impairment write-down, even if market conditions improve dramatically, is significant. We see this debated in areas like cryptocurrency accounting, where current rules often treat them like indefinite life intangibles requiring write-downs for value drops, but prohibiting write-ups if the value recovers. It means reported income can be more volatile downwards, but you don't see the upside reflected in the asset value on the balance sheet until it's maybe sold. It highlights that focus on not overstating assets.
Okay, that makes sense. Beyond these general rules for life and impairment, our source material, Chapter 11, breaks down intangibles into some specific categories. Could you maybe walk us through those main types?
Absolutely. Grouping them helps understand the nuances. There are roughly 5 main categories. First, you have marketing-related intangibles. These are primarily used in the marketing or promotion of products or services. Think trademarks, trade names like Kleenex, Pepsi-Cola, internet domain names, even non-compete agreements sometimes.
So things that help sell stuff.
Exactly. If a company buys one of these, like a trademark, they capitalize the cost. If they develop it internally, like building up a brand name over years, generally only direct costs like legal registration fees are capitalized. Most internal marketing costs get expensed. These often have indefinite lives, so they aren't amortized, but they are tested for impairment annually. Just think about how fiercely Disney defends its Mickey Mouse trademarks and copyrights that shows how valuable these are. Second category, customer-related intangibles. These result from relationships with outside parties. The most common examples are customer lists, order backlogs, and contractual customer relationships. If Green Market Inc. buys a customer list for $6 million and expects it to generate business over the next 3 years, they'd capitalize that $6 million and amortize it, probably straight line over those 3 years. These usually have limited lives. Third, we have artistic-related intangibles. This involves ownership rights to artistic works, plays, literary works, musical compositions, pictures, photographs, videos. The key asset here is usually the copyright.
Like the rights to songs or movie scripts?
Precisely. A copyright grants exclusive rights for a long time, typically the creator's life plus 70 years. Costs to acquire a copyright or successfully defend one in court are capitalized. Then it's amortized over its useful life, which might be much shorter than its legal life. Think about Andrew Lloyd Webber musicals. The copyrights owned by a really useful group are incredibly valuable artistic intangibles. Fourth category, contract-related intangibles. These represent the value of rights that arise from contractual arrangements. Common examples include franchise agreements, think Subway, Marriott, licensing and permit agreements, like for broadcasting or drilling rights, and construction permits. If there are identifiable costs to acquire the contract or right, those costs are capitalized. If the contract has a limited term, you amortize it. If it's indefinite or perpetual, like some broadcast licenses, you don't amortize but test for impairment. Any ongoing annual payments related to the contract are usually just expenses incurred. And finally, fifth category, technology-related intangibles. These relate to innovation or technological advances. The big one here is patents. A patent grants the holder exclusive rights to use, manufacture, and sell a product or process for 20 years. If a company buys a patent, they capitalize the purchase price. If they develop the technology internally, the R&D costs are expensed. We'll get more into that. But the direct costs of securing the patent itself, like legal and filing fees, are capitalized. Costs to successfully defend a patent in court are also usually capitalized. Then the capitalized costs are amortized over the patent's legal life, 20 years, or its useful life, whichever is shorter.
Shorter. Why would the useful life be shorter?
Good question. Think about the pharmaceutical industry. A drug might get a 20-year patent, but because of lengthy clinical trials and regulatory approval processes, its actual commercial life, the time it's generating significant revenue, might only be, say, 8–10 years. So they'd amortize over that shorter useful life.
Okay, that's a great breakdown of the types. So once a company figures all this out, capitalizing, amortizing, testing for impairment, how does it all actually show up on the main financial statements? Where do we see it?
Good question. On the balance sheet, intangible assets are typically shown as a separate item in the long-term assets section. Sometimes they might lump goodwill in there or show it separately. On the income statement, any amortization expense for limited life intangibles and any impairment losses recognized during the period for either type are generally presented as part of income from continuing operations. They might be separate lines or included within operating expenses like selling, general, and administrative. And critically, the notes to the financial statements provide a lot more detail. You'll usually find a breakdown of the major types of intangible assets, their gross carrying amounts, accumulated amortization, and the amortization expense for the period. The notes also often include the estimated amortization expense for the next 5 years, which is really useful for forecasting. So the details are usually in the notes.
Okay, let's circle back to goodwill. You mentioned it earlier. It always seems like the most intangible of the intangible assets. What exactly is it, and why is it often such a significant number on some companies' balance sheets?
Yeah, goodwill is definitely unique. It's often called the most intangible of the intangible assets, precisely because it's not separable from the business itself. You can't sell goodwill on its own, unlike a patent or a brand name. It arises only when an entire business is purchased in an acquisition. And it's measured as the excess of the purchase price paid for the company over the fair value of the identifiable net assets acquired.
Identifiable net assets. meaning the assets minus liabilities you can actually put your finger on, like cash, buildings, patents, customer lists.
Exactly. You value all those identifiable assets, subtract the liabilities assumed, and get the fair value of the net identifiable assets. If the buyer paid more than that fair value, the difference, that premium, is goodwill. That's why it's often called a residual amount or sometimes even a plug figure. It captures all the synergistic benefits, reputations, skilled workforce, etc., that aren't separately identifiable but contribute to the value paid. So if Diversified Inc. pays $400,000 cash for Tractor-Link Company, and Tractor-Link's identifiable net assets, assets like inventory and equipment minus liabilities like accounts payable, have a total fair value of $350,000.
Then the extra $50,000 is goodwill.
Precisely. $50,000 of goodwill gets recorded on Diversified's balance sheet.
Okay, so it only arises from an acquisition. What if a company, like, say, Apple, builds up an incredible reputation and brand loyalty internally over many years? Can they record that internally generated goodwill on their balance sheet?
No, they cannot.
Yeah.
Internally generated goodwill is not capitalized.
Why not? It seems just as real.
The reasoning goes back to measurement reliability and objectivity. How would you reliably measure the value of internally generated goodwill? How would you objectively link specific costs incurred over decades to that goodwill value? It's incredibly complex and subjective. Goodwill is only recorded when it's part of an arm's-length purchase transaction, because that transaction provides objective evidence the price paid for its value at that specific point in time. This is definitely a point of considerable debate in accounting. Critics argue that not recognizing valuable internally generated goodwill means the balance sheet doesn't reflect the company's true economic worth. But the standard setters have prioritized faithful representation objective, verifiable amounts over potential relevance that relies on subjective estimates.
Got it. And since goodwill is generally considered to have an indefinite life, how does impairment work for it? You mentioned no amortization earlier.
That's right. Because goodwill has an indefinite life, it is not amortized. Instead, just like other indefinite life intangibles, it must be tested for impairment at least annually. The test involves comparing the fair value of the reporting unit to which the goodwill is assigned.
Reporting unit. Like a division or segment of the company?
Exactly. A component of the business for which discrete financial information is available and reviewed by management. You compare the fair value of that whole unit, including its allocated goodwill, to its carrying amount, book value, on the company's records. If the fair value of the reporting unit is less than its carrying amount, then you recognize a goodwill impairment loss. The loss is measured as the difference, but it cannot exceed the total amount of goodwill allocated to that reporting unit. For example, if Telling Time Corporation's alarm clock division has a carrying amount, book value including goodwill, of $2.4 million, but due to market competition, its fair value drops to $1.9 million.
They'd recognize a $500,000 impairment loss against goodwill.
Correct, assuming the goodwill allocated to that division was at least $500,000. And, just like other impairment losses under GAAP, once recorded, this goodwill impairment loss cannot be reversed in future periods, even if the division's fair value recovers. Now, this also raises an interesting opposite scenario. What about a bargain purchase?
A bargain purchase. You mean when a company buys another business for less than the fair value of its net assets? That sounds like a fantastic deal.
It does, and it happens sometimes, maybe in a forced sale or if the seller is distressed. In that situation where the purchase price is less than the fair value of the identifiable net assets acquired, the purchaser records the difference as a gain on the acquisition in their income statement.
A gain right away.
Yes. For example, if Meltone Inc. buys Creme Crust for $500,000, but after careful measurement, Creme Crust's identifiable net assets are determined to have a fair value of $800,000.
Meltone gets an instant $300,000 gain.
Exactly. Meltone records a $300,000 gain on acquisition. Because these situations are unusual and might suggest potential mismeasurement of the assets or liabilities, they typically receive significant scrutiny from auditors and regulators. Companies have to be very careful in measuring those fair values.
When you look at goodwill accounting overall, what really stands out to you? What's the most debated aspect?
Well, the whole accounting for goodwill remains pretty controversial, honestly. The biggest debate is probably still about whether it should be amortized or not. Some argue strongly that goodwill does diminish over time, just like other assets, and therefore it should be amortized systematically to reflect that decline, leading to smoother earnings. Others believe that non-amortization, combined with rigorous annual impairment testing, provides more useful information because it reflects the economic reality only when the value has actually declined even if it causes more earnings volatility. The Analytics and Action section in the source highlights this. You see huge spikes in goodwill impairments during economic downturns, like the 2008 financial crisis. That volatility hits the bottom line, which companies generally don't like. It's a balancing act. And the FASB, the U.S. standard-setting body, continues to revisit this. There's ongoing discussion about potentially bringing back goodwill amortization. It's a hot topic.
Okay, let's shift gears slightly to another big area related to intangibles. Research and development costs, or R&D. How do these fit into the picture?
Right, R&D.
Yeah.
It's a huge expenditure for many companies, especially in tech and pharma. Now, R&D costs themselves are generally not considered intangible assets under GAAP. However, R&D activities are what frequently lead to the development of patents or copyrights, which are intangible assets. The accounting rule for R&D itself is actually quite simple, but often debated. GAAP generally requires that all R&D costs be expensed as incurred.
Expensed immediately. Even if the research leads to a billion-dollar drug or technology, why wouldn't you capitalize that investment?
And that's exactly the conundrum, as the textbook calls it. Logically, you'd think these massive investments have significant future benefits. But the difficulty again comes down to uncertainty and reliable measurement. How do you reliably identify which specific R&D costs will lead to which specific future benefits? And how do you reliably determine the magnitude and duration of those benefits at the time the costs are incurred? Because of this high degree of uncertainty, GAAP takes the conservative route, expense it all as incurred. So yes, even if Alphabet spends billions on R&D that might eventually lead to some groundbreaking AI, almost all of that spending hits their income statement as an expense in the period it happens. It's just deemed too difficult to reliably link those specific internal spending dollars to a specific future asset value at that stage. Now, there are always nuances, right? Costs for materials, equipment, and facilities used in R&D are expensed immediately unless those items have alternative future uses beyond the current R&D project. If they do have alternative uses in other R&D projects or regular operations, then they are capitalized as tangible assets and depreciated over their useful life, with the depreciation charge being allocated to R&D expense. Personnel costs, salaries, wages of researchers, purchased intangibles for R&D use unless they have alternative future use, contract services hired for R&D, and most indirect costs allocated to R&D, those are all expensed immediately. But importantly, the direct cost to obtain a specific patent, like legal fees and filing fees after the R&D phase is complete and you're actually applying for the patent, those costs are capitalized as part of the patent intangible asset. That's distinct from the R&D cost that developed the underlying invention itself.
Okay, that's a key distinction. Are there other types of costs that sort of sound like R&D or are related to starting things up but are treated differently?
Yes, definitely. The standards clarify several other related costs that are also generally expensed as incurred. First, startup costs for a new operation. These are the one-time costs you incur when starting a new business, opening a new plant, or introducing a new product or service. Think organizational costs, legal fees for forming the entity, initial training, all expensed. Second, initial operating losses. Losses you might incur in the early stages of a business before it becomes profitable. These clearly have no future service potential, so they're recognized as losses immediately. Third, advertising costs. Generally, these are expensed either as incurred or the first time the advertising takes place.
Even though advertising builds brand value, which is an intangible.
Exactly. While a strong brand, like Apple's, is incredibly valuable, estimated at over $300 billion, the costs to advertise and build that brand are usually expensed. Again, the reason is the difficulty in reliably measuring the specific future benefits stemming from specific advertising expenditures. And fourth, computer software costs. This depends. If software is developed for sale, there are specific rules. But if it's developed for internal use, like a company's own payroll system or an airline's reservation system, the costs incurred in the preliminary project stage and during training and maintenance are expensed, typically as selling and administrative expenses, not R&D. Costs in the application development stage are capitalized, though.
So putting this all together for R&D and related costs, what's the main takeaway for someone reading a company's financial statements?
The main takeaway is that even though R&D investment is crucial for future growth, you won't see a big R&D asset on the balance sheet under GAAP. Instead, you need to look carefully at the income statement to see the R&D expense recognized each period, and critically, read the notes to the financial statements. Companies are required to disclose the total amount of R&D costs charged to expense for each period presented. This disclosure gives you vital insight into their level of investment in innovation and future potential, even if GAAP doesn't allow capitalizing those costs as assets upfront. It really highlights that fundamental tension in accounting between relevance, showing the economic impact of R&D investment, and faithful representation, sticking to objective, verifiable costs, and avoiding uncertain future benefits estimations.
That makes sense. Now, for many of us operating or analyzing businesses in a global context, understanding the differences between U.S. GAAP and International Financial Reporting Standards, IFRS, is really important. How do they compare when it comes to these intangible assets? Are there major differences?
That is a crucial question. Because yes, there are some significant distinctions between GAAP and IFRS in this area. It's important to be aware of them. Let's break it down. First, some similarities. Both GAAP and IFRS generally agree on the basic definition. Intangibles lack physical substance, are non-financial instruments, and must be identifiable, meaning separable or arising from contractual legal rights. They also both require companies to expense costs incurred during the research phase of R&D. So the early-stage exploratory costs are treated the same expensed. But then we get to the differences, and some are quite substantial. One big one is revaluation. Under IFRS, companies have the option to revalue certain limited life intangible assets, like patents or licenses, but not goodwill or indefinite life intangibles, upwards to fair value, if an active market exists for them. GAAP prohibits revaluation for all intangibles. Under GAAP, you can only write them down via impairment, never up.
So IFRS allows assets to potentially increase in value on the balance sheet after initial recognition.
Correct. For certain types, if certain conditions are met. That's a major difference. Another key difference, internally generated intangibles. We talked about how GAAP generally prohibits capitalizing costs for internally generated brands, customer lists, etc. IFRS, however, permits capitalization of some internally generated intangibles, like development costs, potentially even brands in some limited cases, if specific criteria demonstrating probable future economic benefits and reliable measurement are met. GAAP is much stricter here, expensing almost all such internal costs. Another key difference related to that is the R&D development phase. While both expense research costs, IFRS requires capitalization of costs incurred during the development phase, once technical feasibility and economic viability are established. GAAP, in contrast, still expenses most development costs, with some exceptions like certain software development costs.
So under IFRS, you could see capitalized development costs as an asset, where under their GAAP, you just see expense.
Exactly. That can lead to different asset values and different timing of expense recognition. Also, the impairment test calculation differs slightly. While both use fair value concepts, IFRS uses a recoverable amount test, which is the higher of an asset's fair value less cost to sell, or its value in use, which is the present value of expected future cash flows. GAAP primarily uses just the fair value test for measurement after the recoverability test for limited life assets. And finally, impairment reversal. This is critical. IFRS allows the reversal of impairment losses previously recognized for most intangible assets, again, not goodwill, if the economic conditions that cause the impairment have improved. GAAP prohibits the reversal of impairment losses for assets held for use. Once impaired under GAAP, that lower value is the new cost basis, period.
Wow, so IFRS allows you to write assets back up if their value recovers after an impairment.
Yes, for most intangibles except goodwill. This difference alone can significantly impact reported earnings volatility between GAAP and IFRS reporters.
When you look at these GAAP versus IFRS differences, what's the big picture takeaway for you?
Well, the IFRS approach, particularly with revaluation and the capitalization of development costs and potentially some internal intangibles, can lead to higher reported asset values on the balance sheet compared to GAAP. You could argue this potentially offers a more relevant picture, maybe closer to the economic substance or current value of a company's assets. However, it often comes at the cost of potentially less faithful representation or comparability, because it involves more management estimates and subjectivity, especially in determining fair values or assessing the criteria for capitalizing development costs. GAAP tends to prioritize objectivity, verifiability, and conservatism, even if it means some economic value isn't reflected directly on the balance sheet. It's that classic trade-off playing out differently across the two sets of standards.
Okay, so let's try to wrap this up. What does all this mean for you, our listener? We've really taken quite a deep dive into the world of intangible assets today. We went from their basic characteristics lacking physical substance to how they get valued, how limited life ones get amortized, how both types get tested for impairment. We explored the specific categories, dug into the complexities of goodwill, and tried to demystify those often confusing R&D costs. Hopefully, you've seen just how vital these invisible assets are to understanding a company's financial story, its health, and its potential for future cash flows.
Absolutely. Really getting a handle on intangible assets, understanding their unique accounting treatments under GAAP or IFRS, and seeing their impact on the balance sheet and income statement is just crucial for anyone looking to truly comprehend a company's performance and potential. It really helps you look beyond the obvious physical stuff and appreciate the hidden but often dominant drivers of value in today's knowledge-based economy.
So as we finish up, here's maybe a provocative thought for you to chew on, something to consider after listening today. We talked about how internally generated brands, things like the Coca-Cola name or the Nike swoosh, which are arguably among the most valuable assets these companies possess, aren't actually recorded on their balance sheets at their estimated market value under current accounting rules like GAAP. So the question is, are we, as investors, analysts, or even just informed observers, truly getting a complete and faithful picture of a company's most valuable assets from the balance sheet alone? What implications does this accounting treatment have for how we really evaluate businesses, compare them, and make decisions in the 21st century where so much value is intangible? Something to think about. Thank you so much for joining us on this deep dive into the fascinating world of intangible assets. Until next time, keep digging for knowledge.